Investors now scrutinize net zero pledges as financial data. For several years, the investor conversation about environmental commitments was largely about disclosure. Are you publishing a sustainability report? Do you have a net zero target? Are you aligned with recognized frameworks? The question was essentially, do you have something to show us? That question has changed. What investors are asking now, particularly institutional investors managing large fixed income portfolios, is whether the commitments are credible, whether they're supported by capital expenditure evidence, near-term milestone data, and transition plans that hold up to scrutiny. Do you have something to show us has become, can you demonstrate this is real? The shift shows up in the data. The U.S. CEF Trends Report 2025-2026 puts $6.6 trillion in U.S. assets under management under explicit ESG or sustainability labels, with 69% of total market AUM operating under stewardship policies. But a parallel EY survey of 350 institutional investors found that 85% say greenwashing is a worsening problem. And Harvard Business Review research, published in early 2026, found that investor enthusiasm has narrowed into something more pragmatic and risk-first. Investors aren't retreating from environmental considerations. They're getting harder to satisfy with them. BlackRock's 2025 Global Credit Outlook noted explicitly that transition risk is increasingly treated as a direct input into credit assessments for emissions-intensive issuers. The language was careful. The implication was not. Companies whose transition credibility is in question are being repriced, not all at once and not uniformly across sectors. But the direction is consistent enough that it now needs to be part of how finance teams think about their investor narrative. The debt maturity window makes it urgent. The structural urgency in 2026 comes from a refinancing environment that coincides with an escalating transparency demand. More than $1 trillion in U.S. corporate debt is scheduled to mature across 2025 and 2026, much of it issued during the exceptionally low-rate environment of 2020 and 2021. TD Securities estimates that green and sustainable bond maturities alone will climb to roughly $520 billion in 2026, testing the market's refinancing capacity and investor appetite in ways that haven't been seen before. That original sustainable bond vintage is coming due, and the investors holding those instruments are asking whether the companies refinancing them can demonstrate they've actually done what they said they would. Historically, ESG disclosures lived in sustainability reports, separate from capital markets documentation. That separation is narrowing. The companies that will face the most friction in refinancing are those where environmental commitments have been strong in the sustainability report and weak in the operational evidence. Lenders are increasingly able to tell the difference. The sustainability-linked bond market, which ties coupon rates directly to whether companies hit specific environmental performance targets, saw declining issuance in 2025, specifically because companies were struggling to meet their 2025 KPIs. The market noticed. This is not primarily about companies that have done nothing. Most large-cap companies have done something. They have targets, they have sustainability programs, they produce annual reports. The differentiation is happening at the level of transition credibility. The degree to which a company can demonstrate with verifiable evidence that its trajectory is consistent with its stated commitments. What investor relations teams are missing? The company-level evidence is instructive. In March 2024, the Science Based Targets Initiative removed 239 companies, including Microsoft, Walmart, P&G, and Unilever, from its list of net zero committed organizations after they failed to validate targets within the required window. Of those 239, only 17 had subsequently received new SBTi net zero validation by mid-2025. Microsoft and Walmart both retained near-term targets, but their long-term net zero commitments were gone from the record. A separate June 2025 report by Carbon Market Watch and New Climate Institute rated the climate strategies of Meta, Microsoft, and Amazon as poor, citing AI-driven energy growth as a primary factor undermining existing commitments. These aren't obscure companies with thin sustainability programs. They are among the most heavily resourced organizations in the world. The problem is not effort, It's the governance infrastructure to keep commitments synchronized with operational reality. The investor relations function in most companies was not built to navigate that intersection. IR teams are skilled at financial narrative, earnings management, and institutional relationship building. They're often not equipped to assess the quality of sustainability disclosures, explain methodology shifts in ESG ratings, or manage the conversation when a net zero commitment faces technical scrutiny. That gap is becoming more costly. Sophisticated ESG investors, the ones with the most assets and the longest holding periods, are now asking questions in earnings calls and investor meetings that require sustainability expertise to answer competently. When those questions get deflected or answered with PR language rather than data, the implicit signal is that the transition story isn't solid. Private equity LPs, according to FTI Consulting's 2026 ESG survey, are actively asking whether investment committees consider climate and social risk as part of deal approval, not as a reputational question, but as a governance and financial risk question. That standard is migrating into public market conversations. The teams doing this well aren't doing anything exotic. Sustainability and IR review investor communications together before they go out. They prepare data-backed responses to the specific questions that came up in the last call, not generic talking points, but answers to the actual questions. And someone on the sustainability side briefs IR quarterly on emissions performance and methodology movements so that the next investor conversation doesn't start from scratch. There's a specific governance failure that sits at the center of many investor credibility problems. Forward-looking environmental commitments are not being validated against current year performance data at a quarterly cadence. They're made once, reviewed annually at best, and carried forward in investor materials without systematic checks against the operational reality. What that means in practice: a company with a 2040 net zero target that has published interim 2030 milestones may not have a process in place to assess, quarter by quarter, whether its capital spending, supplier engagement, and emissions trajectory are consistent with those milestones. BP's experience is worth noting here. The company had committed to cutting oil and gas production by 40% by 2030 before scaling back the goal in 2023 and abandoning it in 2025, with incoming CEO Murray Auchincloss stating the company had gone too far, too fast. The reputational and capital markets cost of that reversal was significant, not primarily because the original commitment was wrong, but because the gap between commitment and operational trajectory went unaddressed for so long that the correction had to be dramatic rather than incremental. Building a quarterly validation cadence isn't a large technical undertaking. It's a governance decision. Who owns the comparison of environmental commitments against current performance data? How often? And what happens when a material gap is identified? The companies with that process in place will have better investor conversations in every quarter that follows, and smaller corrections when the trajectory needs adjusting. The ones without it are managing toward a version of the same reckoning on a longer timeline. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.